Hello all of you knowledge seekers. Welcome to Knowledge with Alar. So let us begin with book 1 of my series, Modern Value Investing by Sven Carlin. Mindset of a value investor. Chapter 1. So let's begin, guys. Value investing psychology. Quote, be greedy when others are fearful and fearful when others are greedy. Benjamin Graham. I can tell you guys, this quote, Sven Carlin likes to use it a lot, and really it's one of the fundamentals of value investing. You have to not go with the fad, but really do the research and invest in the right time. When markets are down maybe 40, maybe 70%, and you do your fundamental analysis, you can really get a bargain on the market. Because if you do your research and you know that the company is doing good, then why hesitate? Why go with the flow when everyone is selling? You should start buying. But let's get back to the book. 4 things to understand before becoming a value investor. Quote, the single greatest edge an investor can have is a long-term orientation. Seth Klarman. You really have to have goals to be a long-term investor. If you don't have goals, you're going to fail. So the author brings out a couple of points that you really have to take in mind before becoming an investor. Point 1, you can't act rational if you depend on the money in your portfolio for your daily life. Let's say you have 1,000 euros in your portfolio and the stock market crashes maybe 70% and you're left with 300 in your portfolio. How do you react to that? Do you still have peace of mind? You really have to think about these things before you start investing. One of these days I'm gonna do a separate video where I give my opinion about these matters, where you really have to do things step by step and really think about all these aspects before investing. The stock market is really volatile in a short term. It can go 70% down in a couple of months, and you really have to keep that in mind. You really have to be ready for it. You have to take advantage of it even. For a value investor, it is often good when an investment is down 70% because it's like a sale, you know, it's a summer sale. Even Warren Buffett's portfolio has fallen not once but twice, more than 50% in a year. But it's always going to bounce back if you know what you're doing. Second point you keep in mind is that during a bull market, you're going to do worse than the market, you know, because everyone is going on that hype train, you know, and yeah, maybe during the bull market they will do better than you, but it's important to minimize the loss. During a bull market, you are going to do so much better than the market because you find margin of safety in your investments, and you know that it is highly unlikely that your picked companies will go bankrupt because you have done the fundamental analysis. So in the long run, you're going to win. So here are a couple of examples of Warren Buffett's portfolio. His portfolio was down 19% while the market was up 21%. That was during 2000, 2001 and 2002. You know, the dot-com bubble. But Warren Buffett didn't participate in that because he didn't find the margin of safety in it. He didn't understand them. He didn't want any part of them. He wanted safety. And when the dot-com crash came, Buffett earned 26.6%, 6.5%, and then lost 3.8%, so 3 years, while the market lost 9.1% the first year, second year lost 11.1%, and the third year lost 22.1%. So in the long run, Buffett won, you know. He didn't beat the market when times were good, but when times were bad, he did beat the market. And that is a really important thing to keep in mind. We have to minimize our losses, and that is the key to value investing over the long term. So the third point, you really have to be independent. You have to think for yourself, why am I buying something? Is it a good buy? What do I do when it drops 50%? What do I do when it drops 70%? What do I do when it gains, 100%, 200%? When do I sell? When do I buy more? You really have to think these things through, because otherwise you're going to sell at the wrong time for the wrong reasons, You can't just follow the fads, because people usually don't know what they're doing. Yeah, it's really good to buy when others are selling, because these moments create a bargain if you just know what you're doing. Point number 3, value investing is dead boring. You just really have to accept that. It's like watching paint dry. You're not going to get action from it. If you want action, then maybe value investing isn't for you. Value investing is a lot of research, a lot of saying no. You're only buying when all of your criteria are met. It's really about finding intrinsic value of a company, and then when it sells cheaper than the intrinsic value, then you buy. And it's all about waiting and searching and doing research, so it requires a lot of patience, so be prepared for that. It's boring. Quote, investing should be like watching paint dry. If you want action, take $800 and go to Vegas. Paul Samuelson, Nobel Prize winning economist. Before you start investing, you really have to think whether you're an investor or a speculator. If you want to be an investor, but deep down you are a speculator, you're going to do bad decisions when the market crashes 50-70%. People tend to sell when it's down, and they're just not prepared for it. It's really difficult to change who you are deep down. So if you're not an investor, then you're not an investor. You don't have the patience for it, and that's okay too. Every person isn't the same. So, are you a value investor or not? Think about it. Quote, compound interest is the 8th wonder of the world. The one who understands it gains it, the one who doesn't pays it. Albert Einstein. A value investor understands that the fundamentals of a company are in straight correlation with the market price in the long term. In the short term, it's very volatile. If intrinsic value is higher than the market price, then usually the market finds out and the market price will reach the same level. But again, in the long run, it's not going to happen in a year. It might not happen in 5 years, You have to be patient and keep your eye on the fundamentals. If something changes, then you have to know about it. You really have to do your research. An investor has to wait patiently. You have to make yourself a watch list of stocks that have good fundamentals, but maybe not a good market price. So you have to wait until a bargain comes, and then you can buy it, and you know that the buy was good and you're gonna make money in the long run. Quote, my favorite holding period is forever. Warren Buffett. So the difference between an investor and a speculator. Right, an investor is all about fundamental analysis, finding the intrinsic value, comparing it to the price. A trader focuses more on the market price and what the market is doing. So it's really tricky to be a good trader. There are hundreds and hundreds of people on Wall Street doing that as a team. What makes you think you are better than a whole team? Do you think you can beat the market? Thing to really think about. So an investment is when the company that you buy stocks in, you're the owner of that company. And if that company creates value for the money you put in the long run, then that's an investment. It is creating money for you. And yeah, the market is volatile, but in the long run, the market will find the true value of the company and they will recognize that. So the author brings out a couple of traits that a good investor should have. The investor should be unemotional. Every action you do should be rational. You really have to think and calculate why you're doing something. You can't just follow a fad. Fear and greed should be others' weaknesses that create investing opportunities for you. If the stock falls, you have to be confident that the company is good and you are willing to invest when there is a bargain. You have to be able to take advantage of Mr. Market and the volatility. You have to be convinced that the markets aren't efficient, as inefficiency is what leads a value investor to outsized returns. You have to be unafraid to pay taxes on gains and transaction costs, but fearful of unnecessary fees. Capable to clearly distinguish the valuation of a company and its price. Believer that the stock market will provide decent returns in the long run, and for those returns to compound over time. And if you have the following characteristics, I think value investing just isn't for you. You believe that the market is efficient at all time. Thus, the price of the market is also rational and true at all time. You look to the market for guidance. You don't feel confident to buy when the stock is going down. You believe that looking at fundamentals and really analyzing companies is a waste of time. You have the tendency to panic when the market is down. And you think if market is going down, the business must be doing bad. You follow the herd. You become greedy when everyone is greedy, when everyone is buying. And you become fearful when everyone is selling, and so you sell. When you spend little or no time analyzing investments and analyzing companies, you think the stock market is there to make money, especially by using investment shortcuts like leverage or options. You have a really rosy picture of the world when things are going well, and you think there will never be another recession and everything is gonna just keep on rising forever. You think the stocks are the best investment because the yield of bonds is low. When you seek simple investing formulas by projecting short-term patterns into the future. So let's dig deeper into the characteristics of a value investor. Main characteristics of a value investor's mindset. Price is what you pay. Value is what you get. Warren Buffett. The first point was how to be unemotional when investing. Let's look deeper into that. And the author clearly states in the first sentence that, let's be honest, it's easier said than done. It's harder to do when things go bad, but you really have to think these things through, you know. But there are a few tools that you can use to make it easier. First, differentiate between intrinsic value and market-created illusory value and market-created illusory pricing. As a value investor, we really have to differentiate between the real value and the market value. Market value can go to extremes, be it positive or negative. A great example about that is copper. During 2013 and 2017, the price of copper fluctuated from between $7,000 and $4,500. But for companies to even produce copper, the price has to be at least $5,000. So it was certain that the price couldn't stay that low for a long time, because otherwise the companies just would stop producing. So in about 6 months' time, the price was back over 5,000, around 550, and soon at 650. So the bounce back was quite fast. The prices were being pushed down by investing on margin. In reality, the copper might not be sold, moved at all, but it was just made to push the price down, so it was just market being irrational. Mining copper takes time. It's not possible that overnight things change so much. The inventories can't change so quickly for the price to fluctuate 30-40% in a short while. Building a copper mine takes years and years and millions of dollars. So if you really knew how to look at these things, look at the copper price, and you knew the real mining costs and expenses, you knew that it was impossible for the price to stay that low, and it was a great investment opportunity. If you at that time you would have invested in a copper miner, in 6 months time you would have gained like 30%, even more. The more you know about the sector, the more you can find the bargains. The more you know what you're doing, the more confident you're gonna be. So the second point, how to be more rational when investing, is don't put everything into investments. Have some liquid assets, have some cash. When the intrinsic value of a company is 10, the price is 5, it's not smart to put all of your money into that investment at once. The price might easily fall to 4, maybe even 3, maybe even 1. So you should buy in steps, not buy everything at once. So to give an example of this, I'm going to read from the book a chapter about Nevsun Mining, a Canadian miner who really dropped the price in 2015. The price was usually around $4, and toward the end of 2015 the price started to drop, and it dropped to $3.4 as the commodity prices fell. The company had cash for $2.5 per share, and they had liquid assets worth $0.5. So basically you bought something with $3.4 and the liquid assets of that company were worth $3. So we basically got a mining company for $0.4 per share. So to take everything together, the intrinsic value of the company was around $7 and it was selling for $3.4. And when you buy in stages, you lower your risk and increase your return, as the market can always become even more irrational. Now, if you would have invested $10,000 in NSU when the bargain started at, let's say, $2.7 per share, and let's say you would have sold at when the price was 3.5, so you would have gained from $10,000, you would have had almost $13,000. So the return would be almost 30%, and the author has excluded dividends for simplicity. But now for the other case, a value investor should always keep in mind that the price can go even lower. So let's look at the other example. So you would use $2,500 to buy at 2.7, $2,500 to buy at 2.5, another $2,500 to buy at $2.3, and the last $2,500 to buy at $2.1 per share. So the stock price reached 2.5 in December 2015. It reached 2.3 in January 2016 and did not reach 2.1 in that period. So in total you would have used $7,500, and if you would have sold those for 3.5, you would have gained $10,500 while you invested $7,500. So that would have been a 40.6% return compared to the almost 30%. So a lot higher while buying in stages. And the author says partial purchases often give a higher return for less capital involved, which we clearly could see from that example. This is a perfect example how to lower your risks and increase your earnings, which is what value investing is all about. Number 3, portfolio cash cushion. The cash cushion is important, so you have enough money to use when the bargain comes. Seth Klarman at some points in his life has had 50% of his portfolio in cash, and he uses it when the bargain comes. It's quite a good tactic, and Seth Klarman has earned around 20% per year over the long term, so he's a lot over the market earnings. So how to take advantage of other people's emotion? Buy when everyone else is selling. Historical data shows that value investing beats growth investing in 93% of the cases. Index investors usually get the market price minus the fees, and while traders usually don't last one investing cycle because in the bear market they just capitulate. But because value investors really buy value, they buy the company, they really trust in those companies, so they invest even when the times are bad. That is the reason why in the long run the value investor keeps winning most of the times. Really take advantage of the manic depressive Mr. Market. And the truth is, why you really have to take advantage of the recessions is that historically you can see that the recession usually lasts for 11 months and the bull market lasts a lot longer. So when you see that prices are down and you know that the company is good and you buy it while it's cheap, in the next few years you're gonna see that it's gonna bounce back and you're gonna do extremely well. And the market is really going in cycles, you know. There are always bull markets and bear markets, and it is just cyclical, and you really have to believe that it's gonna bounce back. People are still gonna eat food, they're still gonna drive their cars, still gonna own houses, still gonna go to work. Times are just maybe going to be harder for half a year, maybe a year, but it's gonna bounce back, and if you do your research, then you know it's not gonna last long. And the third quite important thing to take advantage of is just know that the markets are not efficient. Okay guys, so that was chapter 1 of Modern Value Investing. The mindset of an investor and the mindset of the market, how to take advantage of it, what you know about yourself, and really just you have to think ahead, you know. Think what you're going to do when the market is down. Are you brave enough? Do you have confidence enough in your research that you're going to buy more? So really, just plan these things ahead and take advantage of Mr. Market when he's manic depressive. Really, when everyone else is selling, that is the time to buy. And in the long run, you're going to win. And yeah, just be rational. Know what you're doing and be smart. So guys, let me know what you think of the chapter 1. Please leave me a comment, give me a thumbs up, and if you liked it, subscribe to my channel, and see you next week. Bye guys.